Hello! Today I'm going to talk you through my 3-account financial system. This is something I'm talking about all the time on my social media channel, so I thought I'd share it in more detail with you today. This is the Looking After Your Pennies YouTube channel. My name is Charlotte Jessup, and today I want to talk you through the system that I recommend for managing your finances, and it involves having just 3 types of bank accounts. I believe in keeping your money super simple, and that's why we don't want to overcomplicate it with having too many accounts here and there. If you're super confident with your money, then by all means have a few extra accounts that reap the benefits and help manage your money in whatever way you see fit. But if you're struggling to get started, then keeping things simple and sticking to 3 accounts could be the way for you. Now, before we start, I just want to put a bit of a disclaimer on this. I am not saying that this is how you have to do it. Personal finance is exactly that. It is personal. So this might not be the right thing for you. I'm also going to be talking about investing and stocks and shares ISAs. And with any sort of investing, your money can go up or it can go down. There is a risk involved. So be careful when you're looking into your investments and make sure that you pick the things that work for you. I will talk you through some of the investment strategies that I use, but that doesn't mean that they are the right ones for you. With that in mind, let's carry on and I will talk you through my system. So like I said, this account system comes with 3 layers and it is a layer system. So I recommend that you build it up. You're going to start with the first account. When you're confident with that one, you're going to move on to the next one, and then you're going to add in the third one. Now you might be the sort of person that has lots of accounts at the moment. And if you're feeling a bit out of your depth with all these different accounts, then maybe it's time to scale it back and just focus on these 3. You might just need to scale it back even further and focus on just 2. And if that's where you are at, then that is fine. And like I say, you can add other accounts in later. But for now, we just want to keep things simple so that we can get super confident in those 2 or 3 accounts, and then we can build up our financial planning from there. The accounts I'm going to talk about today come in lots of different versions. There are loads of different providers for these. I'm not going to sit here and tell you which exact ones to get because it's going to change day in and day out. What I'm looking for is that you go out, use this information to pick the accounts that are the best at the time and work best for you in your current situation. So let's press on and let me start talking about this. So the first one, and the absolute basic when it comes to banking, accounting and managing your money, is a current account. So most people have one of these. This is the sort of bank account that comes with like a debit card so that you can go and you can get money out of a hole in the wall. It's also the sort of account where your pay will go into, and it's also where your bills will go out of. You can have more than one of these, but ultimately the majority of us will have one place where most of our money goes into and most of our money goes out of. And you don't really need this to be complicated. It doesn't need any sort of fancy extras. And it's certainly something that you don't necessarily need to be paying for. There are some accounts out there that will offer you some additional benefits if you want to pay, but look at these very carefully because that's another level of complication. If you're trying to keep things simple, then go for an absolutely basic account that allows you to pay money in and have money go out. Obviously, there are some extra sort of bits and pieces that you can get to go with these accounts, such as overdrafts and things like that. And if that's something that you need, then obviously look into the rates and the interest rates associated with those to make sure it's the right thing for you. But when we're talking about keeping this simple, your current account should be basic. You don't need it to be anything fancy, and you certainly don't need it to be paying you any sort of additional interest, because we're going to use the second type of account for that. One thing that you might want to consider when choosing your current account is how it works for you. So for example, there are a lot of digital-based banks, and there are lots of even mainstream high street banks that have great banking apps now. So you might want to pick one that you particularly like. Look at the reviews, look at the ratings for these current accounts and see what their apps are like, if that's something that's important for you. If you're the sort of person that still likes to pop into a branch, then is there a branch local to you? We want to make banking as easy as possible, so look at all of the different options. Like I said, this is just going to be a simple bank account, so it doesn't need to do too much, but actually being able to use it, access it, if you need to check your bills or you need to check to see if there's been any fraudulent transactions, you need to be able to do that easily and quickly. Another thing that you might want to look at is customer service. If you've ever had to deal with customer service in your current bank, then you will know that you want this to be an easy process. This is your money that you are talking about. So you want there to be a system and a good support team that will help you just on the end of the phone or through a messaging system on an app. Now, the thing to say about current accounts is this should not be a place where you are holding money. This is not a place to keep your cash. We're not going to store large amounts of money in here. So it should just be your money goes in and then it is just like a checkpoint before it goes sent off to all sorts of other different places. Now, I'm not sitting here saying that you should be spending all your money straight away, but what you are going to do is open the second type of account, which is a savings account. Now, savings accounts are going to be the place where you are going to keep money. So ideally, this is where you're keeping things like your emergency fund. So your emergency fund is a pot of money that means that if an emergency pops up, then you have the means to deal with that without going into debt. It's also a place where you might want to think about saving for some of your short-term goals. So maybe a holiday, a new car, or home renovations and things like that. So the reason you want a savings account is to actually store your cash. It's a digital version of a money box, essentially. But the great thing about savings accounts is that you can actually earn some interest on them. Now, at the moment, so I'm recording this in January of 2021, the interest rates are low. Now, I don't imagine that's going to change in the next couple of years, so the chances are this video is probably going to be relevant for a while. But it is one thing to consider is that you need to be getting the best interest rates possible. Now, like I say, you're not going to be able to get anything that's going to beat inflation, which is probably around at least 2%. At best, at the moment, I've seen is around sort of 0.5%. But what we're trying to do here is get the best rate possible so that we are not losing too much value in our money by keeping it in our savings account. The last thing we want is to have our money be worth less when we take it out than it was when we put in. You're not going to be able to actually achieve that, but you are going to be able to prevent some of the damage by putting it in an account that has the best interest rate possible. Now, one of the other benefits to having the savings account to store your money rather than storing it in your current account is it removes some of that clutter. You are not storing all of this money in your current account, which then gets mixed in with all the ingoings and outgoings and all of these sorts of things. It makes it very clear how much you have saved. It also gives you the opportunity to set up an automated savings. So this means that you can set up your current account to transfer a certain amount every week or every month into your savings account. And it keeps it very, very separate. You will be able to track its growth. You will be able to see how much it's in there, and you will see how you are progressing towards your financial goals. Now, when it comes to choosing where you have this savings account, now that is entirely up to you. Some people will choose to keep their savings account with the same company, the same bank as their current account. And now the benefits to this can be that it's easy to make transfers between one and the other, but the downsides can be that you might not be getting those good interest rates. Again, you need to consider things like accessing it. You want to probably go for something that is easy access. So what this means is that you are able to access your savings at short notice. So if there is an emergency that comes up, you will be able to access that savings to use that money to pay for that thing. You do not want to be putting your emergency fund in an account that is fixed term. So what this means is there are some savings accounts where you can lock, say, a lump sum of money away for, say, a year, 2 years, 5 years, anything like that. And basically you will get some sort of penalty if you take it out before then. Normally there is some sort of like waiting period before you can access that money too. If you're talking about your emergency fund, you want that to be in a place where you can say, I need that money today, and you can access that money today. So look for the best rates that you can get on those accounts. Make sure that it's easy for you to get hold of. You don't want it to be some, bank that's only got one branch in the middle of, the Scottish Highlands or something, and you're not going to be able to go there for a few days. Think about how you're going to access that and how easy and convenient that's going to be for you. On the flip side of that, you might also want to make it not too easy. There can be a tendency when you are saving to get into this habit of paying some money into your savings account. Then if it's super easy, you could just transfer it back out again. So there are some benefits to maybe having it with a different company that makes it just a little bit more difficult for you to move that money back into your current account. Now, this is a 3-account system, and I've talked about the first 2, but you might want to consider having more than one savings account. Now, the benefit of having more than one savings account is that you can create sinking funds. So sinking funds are pots of money for you to save for fairly short-term things. So you could create a sinking fund where you pay an amount each month into this pot for Christmas, for example. And this would be a separate savings account. And the reason that you might want to have a separate savings account for that is so that you can see clearly what each of the different focuses are for that pot of money. Now, there are some bank accounts, particularly the digital bank accounts such as Starling and Monzo, that have this feature built into them. With Monzo, it's called pots, and with Starling, it's called spaces, and it's great for creating sinking funds. However, if you want to keep it really simple, you can just go for current account and savings account. And now I will start talking about the third one that you might want to add in. So like I said, if you're just starting out on simplifying your finances and getting a handle on these, then you might want to just focus on your current account and building up your emergency fund in your savings account. When you've got a good emergency fund, then is the time to start considering opening the third type of account. And this is a stocks and shares ISA. So this is an investment account. So an ISA is a tax-free investment account. You can only pay into your ISAs, and there are 4 types of ISAs. I've got a whole other video about this, so I'll drop the link below for that. But into an ISA, you can only pay a maximum of £20,000 per tax year, and that is correct at the time of recording this video. On that £20,000, you will not have to pay tax on any money that you earn within that. So we're talking about investing here. So we're hoping when we put our money in there that it is going to go up. And we're hoping that it's going to go up at a rate that is better than what we are earning in our savings account. The reason that you might want to decide to invest is because the potential gains will probably and hopefully beat inflation in the long run. But your investment account needs to be very much looking into the future. Your savings account is for short to mid-term savings, and your investment account needs to be very much medium to definitely long-term. So this is looking at saving for things like retirement or other things that are maybe 15 plus years into the future. Because this is investing, you need to think carefully about the affordability of this. You need to be putting money into your investment account that you can afford. It fits into your budget. You have it available. And you needs to be money that you are not intending to use for a long time. When we're thinking about retirement, you don't want to be dipping into that in the next year or 2 years, because actually that's when there is the potential to lose money. When you look at investing into the stock market, there is a long-term trend that says if you can put money in and leave it in there for 20 or 30 years, then you have a good chance of making money. However, if you are then looking to take it out in a year or something like that, then you could stand to lose money because the market goes up and down all the time. And 2020 was a fantastic example of that. If you'd have needed to have dipped into your money in, say, April in 2020, you probably would have lost a bit of money on your investments. However, if you'd have been able to have left it over another couple of years, well, hopefully it will have gone up and gone up by a fair bit. Now, I keep my investments with Vanguard. So I have a stocks and shares ISA with Vanguard. The reason I've chose that investing platform is because they have low fees, and fees are particularly important when you're looking about long-term investing. A high fee can really corrode into any returns that you get, and Vanguard have some of the lowest fees in the market. They're also really good for ETFs or exchange traded funds. So these are groups of companies that have been grouped together around a certain thing. So it might be like tech companies or the top 500 companies in the London Stock Exchange. And you can invest in those funds as though you're buying into one stock. So you buy this complete package of companies as though you're buying into one thing. Now, because you're not just investing into one company, you're kind of lowering your risk. You can invest into a whole load of companies, and some of the offerings that they have from Vanguard can be a mixture of things like stocks and bonds and other types of investments too. So I choose Vanguard because I can invest, and I invest in their Life Strategy 80, which is 80% equities or stocks and 20% bonds. And this means that I have a diverse portfolio by only investing into one thing. Now, obviously, this might not be the right thing for you, and it's certainly not a recommendation. It's just something for you to consider. It works for me, and I've been finding it really easy to invest, but I'm definitely playing the long game. I'm investing into this with the view that I'm going to use it for my retirement or for a long way into the future, and therefore that works as a good investment strategy for me. So that's it. That is my 3-account system for your simplifying your finances. You have a current account, which your money goes into and out of. You have a savings account, which is for storing money in the sort of short to medium term. And then you have an investment account in the form of a stocks and shares ISA or an investment ISA that is for longer term storing of money and growing your money. Now, there are some more accounts that you might want to add in. These accounts include a lifetime ISA, which is again another form of ISA, so it will count towards your 20,000 allowance. But this is ISA that you can use for saving for your first home or saving for your retirement, and the government give you a little 25% bonus on the money that you pay in there. So it's another thing that's worth considering if you're looking at buying a house or your retirement. Others are junior ISAs, so these could be for your kids if you're looking at investing for them. I'm going to be doing a video on this very soon to explain my choices around my junior ISAs for my kids. And the other obvious one is things like credit cards. Now, some people, if they've had a bad experience with debt, will want to steer very clear of credit cards, but actually you can use credit cards to your advantage, and they can be very useful for things like building your credit score if you're looking to get a mortgage or some sort of loan in the future. But if you just want to keep it simple for now, you just stick to those 3. Anyway, I hope this video has been super useful. I've loved explaining the system that I've been talking about for years, so I hope that it will give you something to think about in the future. If you enjoyed this video, please think about subscribing to my channel and leave me some comments below to let me know what you think of this system. You can follow me on all sorts of social media channels where I'm putting content out all the time. Anyway, thanks for coming along to watch this video, and I hope to see you in the next one.